Hello and welcome to this edition of Closing Trades. And it's turning out to be a little bit of a rough Friday as we step into the weekend. We're down about 125 points, although we've lifted off from the session highs. At one point in time, we were down nearly about 300 points on the Nifty alone. Is it global weakness that's rubbing off on our markets? Clearly not, because Europe at least has kick-started on a very positive note. We're seeing across the board about 0.5% to 0.7% gains coming in right now. That said, it's important to also take cognizance of how Asia actually shut shop in trade, and there too we are the region underperformers because Shanghai is flat, or rather closed and flat. It was marginally higher for Hong Kong, so clearly we seem to be the underperformers. And Japan managed to close in with a good 650 plus point plus a kind of gain, and that equates to almost a 2% move. Even the US futures are holding up absolutely okay. About 0.5% uptick is what you're seeing across the board, with the Dow as well flat with a positive bias right now. That said, where is the weakness coming in from? Let's analyze that as well. It could very well be just, weekend jitters. There is typically a lot of news flow. There are, of course, tensions building up with India and Pakistan. So a little bit of position adjustment, tactical albeit in nature. That's what's taking place. Look at Axis Bank. Those numbers disappointed. The stock lower by about 3.25% right now. There's Trent, which is down about 3%. There's DRL, Bajaj Finance, Eternals down about 2%, BEL down 2%, Geofinance, which pretty much had a one-way move up ever since its numbers and the kind of commentary that they had on individual segments of theirs. That stock is well lower in trade today. And that's the case with a large chunk of the market. And I would say we're still a lot better than what the session lows were, because at one point in time, you barely had an SBI Life, which was the only standout performer. Other than that, even, a Tech-M and Infosys were just about scratching the green surface. So from there, we've definitely picked up a little bit. And what's picked us up? It's HDFC Bank, which has given up its losses. ICICI Bank has finally covered ground, and Reliance, which started off the day in the positive, has finally now drifted back into the green. It's mildly higher right now, Reliance, as we approach closer to its numbers, although they're going to be only post-market as. But sectorally, is it any winner? When it comes to the sectoral indexes per se, the answer is no. It's only technology, which is a relative outperformer there. But let me welcome on board Narendra Solanki and find out what he's making of the market right now. Narendra, hi, afternoon. Good to have you on the show. What's making the market nervous today?
Yeah, good afternoon. I think from the lows of the April, markets have already run up 11-12%. And I think it was just around, market was waiting for some kind of a news or some kind of a event to happen and then take a pause and go into consolidation. And I think that reason has come in the form of heightened tension across the border and also the impending weekend, 2 days. So a lot can happen over 2 days if we see by the actions and by the commentaries coming out from the official sources. So the traders might not be wanting to go into the weekend with open positions. And I think this 11-12% kind of run up also gives some profit booking rationale as well. So I think people are booking the profit, short-term profits, and the traders are not wanting to go naked into the weekend because of these heightened tensions and uncertainty surrounding the India-Pakistan border. So hence, we have seen these kind of moves in the markets today.
Right. Very good afternoon to you, Narendra. This is Shallow, so joining in the conversation. And like you said, yeah, it's a weekend, it's 2 days. 2 days is a long time, given the fact that every weekend we've come back on a Monday and we've had a new news flow to deal with. In light of that, one sector that actually saw a huge beating was the IT sector. This week actually is going to be the best week in about 11 months for the IT sector, and this is all thanks to the earnings that were much better than what the street were anticipating for the IT names. How are you looking at the sector now? Are you going to actually gauge the sector based on earnings, or are you going to pay attention to the global commentary?
I think as far as earnings are concerned, those were in lines, and what we have to focus is on the commentary and the short and medium term outlook, because definitely there might be some spending cut downs in the developed markets, which might impact the overall sector, but that has yet to be seen, and how deep and how severe turn that could take is also very uncertain. So we are currently cautious on the on the overall sector, and we are taking stock-specific bets. Especially, we are favoring stocks which are much more diversified in terms of industrial offerings into BFSI, manufacturing, as well as R&D. So these kind of diversified presence is there. So we are favoring those stocks in the IT and ignoring a very sector narrow exposure into this sector.
Right, so that's about the IT space. We just had Maruti Suzuki's numbers that they reported a short while ago, and if you look at the numbers, post the numbers, actually the stock actually saw a downtick. Also, the margins were below the estimates. What they're also saying, there's a sudden drop or surprise drop in their profits, and this on back of high discounts as well as expenses. Analysts have mentioned that the company were forced to offer higher discounts, particularly on small cars, and that could have actually impacted the performance in the quarter gone by for Maruti Suzuki. PAT below estimates, margin below estimates. But Narendra, how are you looking at the auto majors, given the fact that Maruti Suzuki is among the first of the major four-wheeler companies to report their numbers, and yes, it is disappointed the street. Now, how are you going to look at that space, be it Mahindra & Mahindra, Tata Motors and Maruti Suzuki?
I think as far as Maruti's numbers are concerned, top line revenue is largely in line. The volume growth is also there. And as expected, the margins were down because of higher marketing spends plus discount offerings. And I think this should carry over to the next quarter as well because the competitive intensity is still very high, especially in the PV segments. And overall, coming to the sector, in the auto sector, we are more positive inclined towards two-wheelers space and agriculture space. And passenger vehicles, we are kind of cautious and neutral. And especially in passenger vehicles, we like much diversified stocks like Mahindra and Mahindra, which is also present in agri space as well. And in two-wheelers, our preferred pick is TVS Motors and Hero MotoCorp. So this is our view on the auto sector right now.
Right, okay, that's the take coming in on where is it that one has opportunities within the entire auto pack, and of course dissecting Maruti's numbers. We will connect the con call at 4 p.m. today. But we're going to take a very quick break on that note. Come right back, we'll continue tracking markets on the other side.
Welcome back. You're watching Closing Trades right here on ET Now. And Pakistan's closure of its airspace to Indian Airlines is expected to cause the longer travel times for international flights from Delhi to northern cities. Industry experts suggest that the retaliatory step taken by Pakistan may lead to a potential fare increase of around 8 to 12% in the short term. My colleague Samir is here with all the details. Samir, over to you.
So definitely after the closure of Pakistan airspace, it is definitely going to bring impact on Indian airlines. So airlines like Air India, Indigo, Akasa and SpiceJet, they have already confirmed that their flights are going to be impacted, especially the flights operating from Delhi and northern cities to West World. So these flights are going to be impacted because now they have to be diverted. They have to take a longer distance or longer routes. And this impact also means that the operational cost of the airlines will increase because now they will have to burn more fuel because of the diversion. And sources have indicated that this immediate impact will bring in an additional cost of around 8 to 12%. This means that the airfare on this route will rise by around 8 to 12% on a short-term basis. On a long-term basis, we may see more impact as well. But as of now, these Indian carriers which flies to West World, to America and other European cities from Delhi and North India, they are going to be impacted very much. They have to opt for the alternate route over the Arabian Sea, and a longer route means they have to burn more fuel and the operational cost of the airline will increase. Now let me tell you that this is not for the first time that this sort of impact or the action has been taken. A similar sort of situation or the action was done in 2019 when India did the airstrike and then Pakistan closed its airspace. Then also the Indian Airlines, they suffered a loss of somewhere around 700 crores. As per the figures that were shared by the sources. And now the same sort of situation has came up where the Pakistan airspace has been closed, and for short-term basis the airfares may rise by around 8 to 12%, and airlines will have to definitely look at what sort of alternate routes they want to opt in, and how they are going to mitigate this impact.
Samir, thanks for that update. That's exactly what the situation is currently with regards to India-Pakistan standoff. In the meantime, the Army Chief General Upendra Dwivedi has also arrived in Srinagar to review the security situation in the region. In fact, top Army officials are expected to brief him on the security measures and counter-terror operations in the valley. Pradeep Datta from the Times Network is here with all the details.
So Army Chief is looking after all these things. He's being briefed by the 15th Corps Commander, and after that he'll also be meeting the commanders from the different Rashtra Rifle units, because Rashtra Rifle units are involved in the counter-terror operation, because they want to see enemy within also, enemy across the border also. So it will be a three-pronged operation that will be conducted in the coming way. Already we have started operation being conducted on two fronts. While as on line of control, they are trying to prevent infiltration, and they are giving a prophetic reply to Pakistani who are violating ceasefire, and inside they are looking after counter-terror operation, where they've already intensified operation. If you look at the situation since Pahalgam attack, there had been 7 counter-terror and counter-infiltration operations. There was one counter-infiltration operation in Uri, where from the 2 terrorists were trying to sneak in. They were carrying with them large quantities of arms and ammunition. Both the terrorists were eliminated. The arms and ammunition that has been recovered from them was made in Pakistan Ordnance Factory or made in China. Then there was another operation in Kulgam. Then there was an operation in Basantgarh area, where one of our para special force personnel was martyred, and then there was another operation going on in Kathua area. So they are looking for those terrorists wherever they are getting information that these terrorists are hiding in burrows, and they are trying to take them out, flush them out, eliminate, identify and kill them.
We were focusing on the valley, and then we suddenly imbalanced ourselves by opening up windows of vulnerability south of the Pir Panjal. Last 2 years, Pakistan has exploited them fully, and now it is. I am given to understand that the terrorists that attacked in Pahalgam actually went north up from Kishtwar. There are routes via the Madu River, Navapachi, etc., and they appear to have gone and struck from Kishtwar down south up in Pahalgam. So I think we need to quickly, plug these gaps in manpower, very quickly plug these gaps in manpower, because manpower is critical for such operations. We need to induct technology at a faster pace. We need to get more Rafales. We need to get 5th generation fighters. We need to get medium artillery, which we are now making in the country, the ATAGs. We must speed it up.
Okay, that's all the latest that we're currently witnessing or seeing on India's retaliation to the Pahalgam massacre. In the meantime, let's just take status check of where the markets are currently at, because it's a little bit of a volatile ride that we've had from where we started off to where we are up until now. Although we've managed to lift off from the session lows, but we're still reeling under pressure about almost 0.7%. And in fact, we've slipped about 0.2 in just the last half an hour or so. SBI Card still reacting to its numbers, down 6.6%. Scient is down 6%. Idea, after that 1% block deal that transpired earlier in the day, 6% lower is where that stock is. And some of the liquid names from within the Adani group, for instance, like an ACC, Adani Green, Adani Ports, they're the ones which are also under pressure as we speak right now. Jatin Gedia too on the show with us to talk about what the charts are reading. Jatin, hi, afternoon. Good to have you on the show. What's the sense that you're getting about the Nifty? Could it worsen from here when we come into trade on Monday? Or do you think we're just lightening up positions ahead of the weekend?
Good afternoon, everyone. So we believe that 23,870, 23,800 was a very crucial support, and we believe that the Nifty has entered into a consolidation phase after the stellar run-up during the second half of April. So I believe that the consolidation is likely to happen between 23,800 on the downside, and on the upside 24,200, 24,250 is likely to act as a resistance. So we believe that over the next couple of weeks, there could be a range-bound price action between this range. So overall, stock-specific action can happen, and sector rotation is likely to happen during this phase. Overall, we are expecting a range-bound price action in the case of Nifty.
We also have Arpit Veriwal joining us right now on the show. Good afternoon, Arpit. And Arpit, you have the IT index this week is going to post the best week in about 11 months or so. What cues should people take from this? Do you think that now the charts will indicate that there will be a breakout anytime soon in the IT index and can look at it, or just wait and watch?
So very good afternoon to all. If you look at the overall Nifty IT index, so good bounce back move we have seen from last lower levels. So mainly this was the index that was underperformed for last many weeks. And if you see it's from the setup wise, it has retested from its major support zone from 31,000, 32,000 levels towards 35,000 levels. Now looking at the overall chart specific wise, we're expecting that selective IT stocks likely to outperform. And as the result earning season is on, so definitely there will be good action. If we talk about the overall IT index, so selective pockets such as persistent or HCL Tech definitely looks good on chart. So more of stock specific action would be seen with the Nifty IT index, as the major pen has already been discounted. And going forward, definitely the stocks that to watch out for would be HCL Tech and persistent for next couple of weeks time.
Right, okay, that's the take coming in on which way the market is headed. Today, of course, it's been a lot about specific movers when it comes to earnings, and I want to just pull up what Tech Mahindra's performance is like. Yes, IT has been resilient, and even after Infosys's numbers, you did have Infosys actually jump up, and since then, through the last week, we've seen IT lead the rebound for the markets. Tech Mahindra too is holding up about almost 1.5% as we speak right now, and similar is the case with some of the other IT majors as well. And they are reacting to their numbers. Look at Assign, for instance, that's getting clobbered, down about 6%. But that's not the case with the Persistent. That came out with a good set of numbers. Numbers still holding up 2.25%. The stock, that is. Coforge also higher by 2%. And Emphasis as well is going strong by about 2.6% as we speak right now. That said, let's take stock of what else is on the focus when it comes to the markets. And Narendra, all eyes are going to be on Reliance Industries, wondering what you're penciling in terms of what the numbers would bring in. We are anticipating that it's actually going to be Geo, which is going to be the best performing vertical. But what are your thoughts?
Yeah, definitely. The telecom business would be one of the key performers. Along with, I think retail should also perform good, at least in line. I think the challenge for the Reliance comes from its O2C business, wherein we might see some kind of a sustained pressure and the margin pressure as well. So I think OTC would remain a bit challenging, while in terms of telecom would be performing very well, would be the top performer of the overall pack, and then followed by the retail.
So that's the take coming in on Reliance Industries. On that note, thank you so much, Narendra, for joining us on the show. But talking about Reliance Industries, let's get Varun on board to exactly tell us what the street is penciling in when Reliance Industries comes out with its numbers post-market as today. Varun, over to you.
Well, we are expecting a soft quarter for Reliance Industries, wherein the overall revenues are expected to grow by 0.5% and the profit is expected to decline by around 0.4% and come at around 18,471 crores. We are expecting a decline of 1% in the EBITDA, and the EBITDA margins are going to decline by around 25 basis points from 18.25%. They will come down to around 18%. Now, the overall weakness will be in the oil to chemical and oil to gas business, oil and gas business. The EBITDA actually would decline, but it would be offset by the digital and also the retail business. Now, the benchmark Singapore GRMs are down around by 58% on a year-on-year basis because of weak global product cracks, and this is going to impact the oil and gas business. Now, for the oil to chemical business, we are expecting a flat EBITDA on a quarter-on-quarter basis. On a year-on-year basis, the EBITDA will decline by 12 to 14% on weak product cracks and also petchem spreads. Although there was an increase in deep water gas prices by around 2% on a YOY basis, but the production in KG D6 block is expected to decline, and that would hurt the overall oil and gas business. Now, when we come to Geo, the overall EBITDA is likely to grow by around 2% on a quarter-on-quarter basis and 16% on a YOY basis. and this would lead to an increase. This is because overall increase in ARPUs, which is expected to increase by around 1% and come at around 2.205 rupees. Now, if you remember, Jio has taken price hike and that is impacting the overall ARPUs and also the EBITDA for Jio. When it comes to retail segment, on a year-on-year basis, we are expecting a 10% increase in overall EBITDA, and it is expected to come around 6,412 crores. But on a quarter-on-quarter basis, you will see a decline in overall EBITDA for retail business. This is because of high base in the previous quarter, which also had the festive season impact. So, in a nutshell, if you look, overall results for Reliance Industries is expected to be muted because of the oil and gas business, the oil to chemical business. Jio would be good, retail on a year-on-year basis would be good, but on a quarter-on-quarter basis, it would be subdued.
All right, thank you so much for that, Varun, for telling us what to expect from Reliance Industries when they report their numbers post-market hours. Monday is when you'll see the reaction to the numbers for Reliance Industries. But on that note, we slip into a break on this edition of Closing Trades. Last half hour of the trading session left, and we'll chart the markets for you on the other side.
Back with Closing Trades right here in ET now, and back to getting a little bit nervous. We're pretty much headed in closer to the session lows. We're down about almost 190 points for the Nifty futures as we speak right now, around the 24,180 thereabout mark for the Nifty futures, and defending the 24,000 mark for the spot Nifty so far at least. But Gurmeet Chadha too joins in on the show right now. Gurmeet, hi, afternoon. What's making the market nervous? Because it seems like we're the only market which is down amidst the entire world.
Hi, Aisha. I think it probably it's difficult to do, but looks like it's by the price action. It's more to do with market sensing some escalation at the border between India and Pakistan, and that's the reason India probably is the only exception today on Friday, despite global markets doing better. Also, we've almost had a vertical 2,000 points kind of a nifty rally. So it's just that, and you have a long weekend ahead. So maybe some, people want to probably take some risk off the table. But that's fine. I mean, considering the pullback we've had, some kind of consolidation, considering what is happening around the border, could be a small bit of a risk-off trade.
It seems, but can't help talk about what's happening in the market right now, wherein you are seeing pretty much all sectors under pressure and a lot of steep and stark earnings reactions, if you will. Look at an SBI Life, for instance. That stock, even though it's come off from the top of the day, but it's still holding on to a gain of about 5%. Emphasis is a big mover. Persistent has been holding for a second consecutive session. Gurmeet, it really is seeming that the market has been very quick in handing out the report card up or down for the entire IT pack, and somewhere you are getting the signs that maybe at least stock-wise, the sector could be at least close to bottoming out. What are your thoughts?
Aisha, I think this is how market should be. I think reaction on earnings, good earnings, you are rewarded. Poor earnings, you are punished. This is what you would want in the medium term and long term to play out. So if you see, for example, in IT, poor earnings, wherever the earnings were soft, IT stocks reacted negatively, whether it was Infi or TCS, and we saw HCL actually, doing relatively better. Similarly for Persistent, the markets have been pretty more kind there. Similarly for banks, ICICI, HDFC, and some banks actually reported good set, and you saw a slightly average or I would say softer number from Axis today, and hence action. So my sense is this is how it's going to be, because in an environment where growth is slightly subdued, global growth will come off, and we are looking at high single digit or maybe early double digit, and earnings on a best case. You are trading at 18, 19 times forward, so there is not much margin for error, despite the price correction we have seen from top. So I think the best hedge in this environment is earnings, and don't look at it only from a sector perspective. I think wherever within sectors we have seen diversion, good earnings being rewarded and bad being punished.
Right. So that's the take coming in when you talk about the earnings performance and how the stocks in the sectors are getting impacted on back of that. But let's take a look at some of these other counters also that are in focus in trade today. You have Emphasis also that is reacting to the numbers. Strong deal pipeline. The Q4 revenue also saw good growth. On the other hand, you have Laurus Labs that is decline in trade. The analysts have flagged off weakness despite the Q4 earnings being upbeat for this one. Cyient also has fallen after its numbers. Reliance has actually eased off a tad bit just ahead of its numbers. Jatin, let me get your view actually on Reliance Industries. How is this one looking on the charts to you? And do you think that this one will be able to lead the markets higher going ahead? Because everyone's waiting for that one outperformance from Reliance Industries.
See, on Reliance Industries, we believe that the stock has witnessed a decent run up from the lows of around 1120 to 1320. So the major part of the up move has already happened. So post this earnings, I think there could be a dip towards 1260 on the downside, and thereafter we might resume the next leg of the up move. So I'm expecting one leg on the downside towards the support zone of 1250, 1260, and thereafter we can expect a resumption of the up move. So post results, we might just see a dip towards 1250 odd levels.
Axis Bank, in case you're wondering why the stock is weak after its numbers, even though you haven't seen any sharp reaction from the brokerages in terms of their target price revision, here's Gaurav telling us what's actually wrong with those numbers. Gaurav?
Well, yes, let's talk about Axis Bank's numbers, and when we look at the numbers, they fairly look in line. In fact, when we talk about profitability, that was actually higher than what the street was expecting, because there was a one-off impact of around 800 crore rupees of reversal in provisions. But let's understand why the stock is not reacting positively. In fact, when we look at the stock performance, it is down more than 3%. So we have got a few points here. First, let's talk about the overall performance. If we compare Axis Bank's returns with all the peers that they have reported, in fact, in the likes of HDFC Bank and ICICI Bank, we've already seen that these banks actually reported numbers which were actually higher than what the street was expecting. But if we compare these numbers with Axis Bank, bank came up with inline set of numbers. When we talk about FY26 outlook also, these banks actually gave a very positive outlook. When we talk about Axis Bank, we got a positive outlook, but street is still unclear if the loan book growth is going to be higher than the industry average growth. And when we talk about deposit growth, although it was very strong, let's also understand and focus on the second point here is the loan book growth, because in this fourth quarter we have already seen that the loan book growth was as low as 7.5%, which was actually lower than the industry average growth that we have seen. And at the same time, there is ambiguity if this loan book growth will remain or increase in FY26. Although management has clearly stated that in FY26 growth and profitability both will be in focus and both will increase, but there is still a little ambiguity. Lastly, let's also focus on the credit cost part, because now management has said that in FY26 credit cost is likely to stay a little higher than the normal level because of the asset classification tightening that they are doing. So there is another point of concern about asset quality and credit cost, which is actually causing some pressure in Axis Bank. But all in all, a very inline set number is what we saw in Q4. Brokerages are also a little bullish on the stock, but as of now we are seeing a negative reaction in the stock price.
Right, thank you so much for that, Gaurav, for outlining exactly why Axis Bank is reacting the way it is in today's trading session. 4%, almost 4% on an intraday basis is the downtick that actually Axis Bank logged in. Let's take a look at what Bank of Maharashtra is doing at this point in time, because that one also came out with the numbers a short while ago. You also had the likes of Hindustan Zinc, Motilal Oswal. These are some of the counters that have come out with their numbers. And Chola Investment also, that one is flashing bottom of your screen. 0.5% uptick or so coming in on that particular counter. Gurmeet, I wanted to get your view actually on the NBFC space. Too much has been spoken about banks of late, given the fact that they were in a very reasonable valuation zone and everyone was actually parking their money in the banks. I believe that that one or that sector will lead the growth going ahead. But what about the NBFCs? Do you think that they merit to?
The quality ones have actually already outperformed. Look at what Bajaj Finance has done after virtually not doing anything for 3 years. And the guidance also in this book, large book now is upwards of 30%. The leadership transition issue is behind. That was one overhang on the stock. We just seen Chola numbers came in while we are the numbers are flashing optically. If you see the NIs are again up 30%. So well-run NBFCs where cost of funds, especially the AAA rated ones, there's an immediate impact on cost of funds. They do not have CASA per se. So today a AAA 1-year rate is around, let's say, 7%. That's like 50, 60 bips lower than what it was. So incrementally now, with cost of funds coming off and credit quality being under control and better managed ones having very little exposure to microfinance or the vulnerable section of unsecured loan, would probably tend to outperform some of the other ones which have a higher share of unsecured loan and microfinance. Also, I think housing finance also, as a group, you should see relative outperformance again. So I'm pretty constructive, but again, here you have to be a little more selective and not just put everything under one basket.
What's the take on insurance? And I was just looking at SBI Life's numbers. The margins look healthy at about 27.8%. They've guided for FY26 in the range of about 27 to 28%. Yeah, the commentary on regulation is a little bit hazy, but other than that, the entire segment, because it's really not been able to take off as one would have anticipated, given the kind of opportunity that it has, as a structural theme.
So, I think numbers are better. Also, not only in terms of the APE growth, which is annualized premium equivalent, or VNB, which is value of new business premium. Also, in terms of ratios, persistency ratio, the overall mix, SBI had a very high reliance on non-PP products versus PP. So I think the mix is also coming back. I think which has a long-term impact on margins too. And insurance, Aisha, as a sector, has been underperforming and under-owned within financials. So maybe because after, if you look at HDFC Life, the 3 year back, the high was, I think, 750 or 770 or something. You're still at roughly around 700 levels. Same is the case with ICICI. SBI relatively has been slightly lower in terms of valuation. So bit of valuation comfort, bit of underperformance over last 2-3 years, and the fact that it is under-owned could drive some near-term interest. But I'm saying, structurally speaking, this will give you market returns in line with what, let's say, a bank nifty or a financial index gives. I think to probably do a little better, you need to be probably anchored with well-run NBFCs and some good private banks which are outperforming the market. So if you look at ICICI Bank, for example, 18% kind of a growth sustained in this environment with pristine asset quality and unit profitability metrics and core PPOP looks clearly stand out. So I think you got to be where there is relative outperformance happening, not only in terms of credit and deposit growth, but also in terms of asset quality.
Arpit, let me come to you actually, and let me switch gears and move to actually chemical space. I wanted to understand what's your view on that, on the charts. How are these chemical names looking to you?
If you see overall, the chemical space has been quite outperforming in the last couple of months, and particularly if we talk about stocks such as SRF or UPL. So, in spite when we have seen good turmoil in the market, but these sectors were holding well. And within that, if we look at the chart structure of SRF, so technically a classical range breakout on the monthly scale after almost 3 years. Trading at life high territory in spite of market weakness, trading comfortably above 2800 2900 levels. So I think SRF looks technically very strong on this in this space. Along with that, UPL and Chambal, all these three stocks are looking very strong on the chart wise. So today we have seen some cooler from the higher levels, but going forward, as soon as we see some recovery in the market, definitely this space is likely to outperform. And from here on also, the stocks can be good buying opportunity at lower levels, because the bigger trend of the stock is positive. So SRF, UPL and Chambal, all three would be our preferred picks within this space.
Okay, that's the take coming in on the entire chemicals pack and how that has been faring and looking. Tech Mahindra, they've reiterated their FY27 goals of revenue growth above peer average, a bit margin of 15%, ROCE of 30%, and of course distribution of 80%, 85% actually of FCF to shareholders, which is why the brokerages have liked this, this particular counter and how the earnings have panned out. Just looking at the rest of the market, and I want to check in on what Reliance is up to ahead of its numbers. Absolutely flat, although it's had a bit of a tumultuous ride, much like the markets today. Started off in the green, dipped from there, languished for a little bit, and now again on its way to recovery. Gurmeet, are you anticipating any magic from RIL? Has been a significant underperformer as opposed to the rest of the market even in the last 1 month, and we're not really expecting any big performance from the O2C segment at least. But do you think Jio can really pull the magic up?
Well, I think Jio will probably have a bit of a better performance vis-a-vis an O2C as well as retail. Retail likely to be a little more subdued, O2C more flat to subdued. And there'll be some benefit Reliance has because of better mix in terms of 4G and 5G. And the fact that the ARPU could see a 3-4 rupees incremental movement, maybe from 203 to 2067, if my memory serves me right. But I think the bigger play, Aisha, for a bigger re-rating is, whenever Reliance does capex, which is what it did from 2013 to 18, it sees underperformance because the street gets worried about debt and lack of cash flows. And similarly, last 2-3 years they have been undertaking capex in new energy, and anyways, telecom is always ongoing. I think market would want to see some monetization, some clarity on the Geo IPO, some monetization even on the energy business, which took off and got shelved with Aramco deal not seeing the light of the day. I think that's what would be to me a bigger trigger. So if you see relative last 1 year, Bharti has been what 40% up, if I'm not wrong. Reliance has been pretty flattish, although right. So I think Geo can probably cushion off some softness in other businesses. But the big trigger to me is monetization and street wanting to see that the incremental capex is coming off and free cash flows are going up.
All right, so that's the take coming on Reliance Industries. Let me quickly take the BTST ideas from our experts. Jatin, you go first. Any BTST ideas?
Its support zone. So Chola Finance becomes a buy or a buy BTST trade for Monday. I think that there is a room for the stock to move it up from current levels. So Chola Finance is a buy. On the upside, I am expecting levels of 16.25. One should keep a stop loss of 15.20 for this recommendation.
Right. What about you, Arpit? Any BTST ideas?
So if you see overall, the cement pack has been outperforming, and if you look at the chart wise, also Ultratech is quite strong. So technically, on the monthly scale, it has given a range breakout after almost 9 months. Daily scale, it is holding well. Good recovery seen from intraday lows. So I think definitely from here on, we can see good live highs in coming couple of sessions. So Ultratech would be a preferred pick within the cement pack. One can go long at current level with keeping stop loss of 11,800 for an upside towards 12,600 levels.
Okay, that's the take coming in on some of those BTST ideas. But Gurmeet, other than that, where do you think the month of May is going to head amidst all that uncertainty still on tariffs at a global level? For our markets, other than earnings, what do you think could act as a trigger?
I think RBI's change and pivot, not only in terms of just rate cut or stance, more in terms of liquidity communication, that liquidity has to be around 1% surplus of the NDTL. The overall guidance, how they want to support growth, I think is spelled out clearly that the regulator now is pro-growth versus a more balanced approach last year. So that I think is well. I think also they were micromanaging some stress assets, whether it was unsecured PL, whether it was gold loan. They took actions on IPO financing. So I think somewhere they want to now, not strangulate or overregulate. So I think that to me is one trigger because of which rate centers and financials will continue to do well. Also, I think you probably will see a bit of a movement. So in US they are calling it Wall Street to Main Street. In India also, for example, you will see. So I think you have to focus on where government is wanting more money, more investments to come in. For example, 22, 23, who would have thought defense, railways, and PSUs will make money, right? They were so underowned. I think that is what's going to be the street needs to focus on. Focus where the deals are happening in terms of bilateral deals. So next 2-3 months, you need to probably navigate well and be more on a preservation mode. Do not be very aggressive in the market. Every year you can't make 20%, 25%, and see where are the low-hanging fruits in terms of valuations, what is underowned. So I think a good mix today, even, and I've been saying this now for a while, the bond portfolio still can give you double-digit return. When we spoke last time on this, I told you the 10-year bonds were around 7% 6 months back. So if you bought even a government bond, your last 1 year return is double digit. I think with RBI cutting rate, even that is conducive. So I think having a very balanced asset allocation right now, a bit of bond, bit of gold, equity, be little more large capish or industry leaders, would help. And once these things is out of the way, that's when you focus on where the deals and treaties are happening, and that's when you get into export opportunities. So I think resetting not only from the market point of view, your expectation point of view is extremely important.
Right. Gurmeet, what's your take actually coming in on some of the realty names? Are you looking at that particular space at this point in time, given the fact that a lot of call is for domestic-oriented sectors, and realty is one of them?
I believe that probably a large part of the return is behind us. Whatever we have seen is the launches have been more on premium or mid-premium segment. The lower end hasn't seen much, and probably we are at the mid cycle in a lot of geographies as far as real estate prices are concerned. And there is a bit of a rub off when other asset classes like equity don't do well. There's a bit of a rub off, especially if you're only into premium projects. You can be geography wise selective on it. So, for example, DLF might come up with a REIT and monetize its retail assets a little more here in North. I think some of the South based players have been doing a little better with its Brigade, etc. But I think the bigger thing would be more consumer discretionary spending, right? And I think that is where on the consumption side you should be focused on, especially where the next generation, the Gen Z spends, which is your travel play, your tourism play, your digital consumption plays. So you have to relook at the consumption basket again and see where it is going. So to me, it was more white goods, electronics, travel, tourism, as far as consumer discretionary is concerned, versus the traditional FMCG or real estate plays.
Interesting that you say that. So, Gurmeet, even at the current valuations within the entire consumption and, the new generation consumption, if I could call it that, where are you finding opportunities?
So, we bought some hotel stocks. We've been very early into Indian hotels and Lemon Tree. We have Indigo, Interglobe in the portfolio now with 65% market share. There could be some short-term disruption right now because of airspace issues, but this is more momentary. We have some plays like Zomato in the portfolio, although there's been last 2 quarters have been a little soft. We are evaluating some new plays, and to me, the capital market plays, something like a CDSL or CAMS or some of the asset management companies are also digital consumption, which is the way new generation does. So you have to make a portfolio. And then we have white goods, some of the plays, including Trent. Then we have Voltas and Blue Star in the portfolio. So we are trying to basically have a diversified consumption basket, more on discretionary and less on FMCG staples or real estate heavy names, which are the traditional FMCG, traditional consumption baskets to be in.
All right, so that's the take coming in on the consumption space. But let's take a look at Shriram Finance. They've just come out with their numbers. The stock has actually taken a nosedive, 7% downtick coming in for Shriram Finance. We'll try and dwell further as exactly what's gone wrong in the numbers. No doubt, if you look at the NIMs on a quarter-on-quarter basis, there's an easing of the NIMs. It's coming at around 8.25% as against 8.48% on a quarter-on-quarter basis. The gross NPA, net NPA, they've bettered actually on a quarter-on-quarter basis. The board has said that they've approved the proposal to offer payment services through mobile wallets and prepaid cards. The AUM has seen a growth of about 17%. The PAT and NII, all of them have actually seen an uptick. And if you compare it to the ET Now poll, the numbers are exactly in line with estimates, Aisha, but not sure what exactly is marring the performance. 7% downtick.
Yeah, considering the NPA, ease off has been quite significant for Shriram Finance. But this is one of those very leader portfolio stocks, and I don't think it's fallen too much as well in the market fall, or even if it's fallen, it's recovered as much swiftness in the last 1 month. If we can just bring up how the stock price has performed, we will get more details, because what I see, the net NPAs are flat on a sequential basis. The gross NPAs have seen quite a significant improvement as well. And the NIMs, it's a slight bit of dip that they've seen, but at 8.25%, I don't think those numbers look all that bad on a sequential basis. But the stock definitely is tanking quite a fair bit. About 7% is the knockoff that it's currently looking at. Where else is strength? It's largely within the entire mid-cap technology space, led by Emphasis, Persistent, Coforge. They're the ones which are holding out. SBI Life continues to be in the dominant position after its numbers. And other than that, you're not really seeing any material movers from within the Nifty, at least. Yeah, there is TechM, there is a TCS Infosys. but nothing meaningful of a move is what you're seeing from these counters. Unilever flat, Reliance a little soft as it steps into its numbers, and flat for ICICI Bank as we speak right now. Gurmeet, any opportunities you think within staples that one could look at?
The food part, Aisha, can do well. So Tata Consumer, for example, has done relatively better compared to the normal FMCG name. See, if you are at 50, 60 times even post correction, and you are giving 2-3% volume growth, I don't think this is a market for that. So you got to be a little careful there. So I think the food part, especially Tata Consumer, I also think ITC to a certain extent has been relative underperformer, but that's what ITC does. Doesn't do anything and do that. And at some stage, maybe the QSR space could look good, but that's been an underperformer for a while. But with input inflation coming off, a lot of them like Westlife, Jubilant now reaching that critical part in terms of the number of stores, focusing more on store profitability. So I think that could be an interesting place. See, Haldiram got valued at 85,000 crores. The entire QSR space, all listed space, is less than 60,000 crores. And with the kind of changing food habits we have, there could be some winners here. But that could be more long run, not nothing from an immediate perspective.
All right, then we leave it there. Thank you so much, Gurmeet, as well as Jatin and Arpit for joining us on the show to give us a take on the markets, given the fact it's the last trading day of the week. Yes, it's been a volatile one at that. When you talk about the markets, we are sub that 24,000 mark for the Nifty, and Sneh is standing by to take us through the closing.
Well, absolutely. So sub the 24,000 mark. In fact, we're just around the 24,000 mark as we speak. Remember, the day's lowest point was 23,847. So we were struggling to even hold on to that range. And we've seen a recovery of 150 points from the day's low. Nonetheless, on an overall basis, we're 250 points lower on the Nifty today, a 1% cut coming in on that front. Let's take a look at what Nifty Bank is up to. A further cut coming over there, 1.1% cut coming in on the Nifty Bank as well in today's trading session. It almost 650 points lower almost on Nifty Bank. Sensex as well, 0.8% cut coming in. So Sensex also in tandem with what the Nifty is up to. But advanced decline ratio all through the day has been steeply in favor of the decline. Still on the back of that, India Wix has also spiked up and has been on a one-way trajectory in today's trading session. A 6% uptick coming in on India Wix. It's the earnings candidate like SBI Life that has done pretty well, a 5% uptick over there. TCS, Tech Mahindra, Infosys, all of these counters have done well, keeping Nifty IT afloat in today's trading session. That was the only winning sector in today's trade. On the flip side, we've just had numbers coming from Shriram Finance, a steep cut coming in on the stock posted numbers, although the first cut seems largely in line. Adani Enterprises and Ports were in the red. You had Zomato, Trent, Axis Bank, Apollo Hospitals, Axis after its numbers yesterday. That stock is under deep pressure in today's trading session. Like I said, Nifty IT biggest gainer today. On the flip side, media and realty were your big losers today, followed by PSU Bank, Pharma, Metal, Energy and Auto, and Nifty Bank in that order. Talking about some other earnings reactions, you had Maruti Suzuki numbers that came out. So Shriram Finance and Maruti Suzuki numbers are out from the Nifty pack. All eyes are going to be on Reliance because on Monday, because these numbers come out post-market close today. So Reliance absolutely flat, but a 2% cut coming in on Maruti Suzuki in today's trading session. Stocks that took a big hit today, Cyient, Macrotech. On the flip side, Emphasis did very well. Vodafone and Airtel both were in the red in today's trading session. So these are some of the top losers when you talk about today's trading session. Cholamandalam investment numbers also came in and they look pretty decent. Bank of Maharashtra as well, good set of numbers. So these are some of the earnings reactions that we've seen in today's trade. But nonetheless, we seem to have closed around the 24,000 mark. We'll give the rate some time to settle. Still higher from the day's lowest point, but much lower from the highest point, if you could call it that. And that's a 1% cut coming in on the Nifty. That's how we are shutting shop for the day.